Hello, everybody. Welcome to the Finance Fundamentals webinar. I'm really excited to have you all here. So just so you know, the webinar is being recorded and you will be sent the link later on. And also all views expressed today are my own and not that of Small Business Britain or eBay. I am Gauri Kuber, and I'll give you a brief introduction about myself shortly. So what I'm hoping to do today is just demystify accounting a little bit for you. So the next time you do your books or you speak to your accountant, you know what you're talking about. The agenda for today includes a short introduction about myself, bookkeeping basics, a little bit about bank reconciliations, and also factors affecting pricing and margins, accounts, both management accounts as well as your statutory accounts, so your year-end accounts, and question answer if time permits, but I'll send you my contact details anyway, so you can get in touch if you want any questions answered. So about me, I am Gauri Kuber, and I actually qualified in 2002 as a chartered accountant from India. I got married, moved here into the UK in 2003, and in 2005, I joined Deloitte. I had to redo my ACA in the UK because my Indian qualification wasn't fully recognized. So I got that done in 2007. By 2011, I'd had 2 kids and I wasn't very happy with the corporate life as well as my work-life balance. So I decided to leave Deloitte in 2013. And in 2014, I set up my family business here in the UK, which was importing goods that my family manufactures in India. And distribute them and retail them here in the UK as well as export them. And that's called Holy Lama Naturals. And in 2021, I guess it was a culmination of my accounting background as well as the knowledge and experience that I'd gained running a small business that I set up Cube Solutions with a view to provide affordable accounting solutions to small businesses. And in 2022, I joined the board of an amazing charity called Epic Arts as a non-exec treasurer. And well, it's a UK charity, but it does all its work with disabled young people in Cambodia. So very exciting time. Right, so jumping straight into the bookkeeping basics. All of you must have heard of double entry. Now, I like to describe double entry as, well, with the help of Newton's third law of motion, which is for every action, there is an equal and opposite reaction. And that's exactly what double entry is all about. So you can see on the right side, there is a balance with debit and credit. And if you follow double entry, the debit and the credit will always, always balance. Now, to give you an example, if you were purchasing an asset, so for example, you want to buy a computer for your business, if you pass an entry in your books, there will be the debit to the asset. So when you buy the asset, the debit increases in that asset. And there will be a corresponding equal entry, which will be either the reduction in debit, another asset, which is essentially money in your bank account, or you could have taken a loan in order to buy this computer. So there would be a credit increase, which is the loan in your account. So a debit increase with a corresponding debit decrease, or a debit increase and a corresponding debit increase, credit increase as well. So you can see it will always, always balance. So debit increase, debit decrease, debit increase, credit increase, that way. So that's the balance. So that's what double entry is all about. For every debit, there will be a corresponding, so every positive debit, there might be a negative debit or a positive credit. So just to give you a brief idea about double entry on that. And then once all the double entries have been passed, what you will see is in your ledger accounts, you will see all the transactions that relate to one particular account will be under one ledger account. So to give you an example, if you're spending money on advertising and marketing, all the transactions that relate to advertising and marketing will be under the ledger account that's called advertising and marketing. So that's all ledger accounts mean. It's a collection of all the transaction that relates to one particular account. Now, a small tip here, when you are setting up your accounts or even if you have been trading for some time, because most of you have been trading for over a year, it might be a good idea to split up your ledger accounts to give a bit more detail to your accounts. So for example, sales. If you have a sales channel, so for example, you're selling via eBay and you have a sales channel, instead of having just a generic sales ledger account, you can break that down into sales, eBay. If you're exporting to Germany, for example, you can have that as sales, Germany. So you can break down your ledger accounts into lots of detail, depending on what you want to analyze a bit more. And the same thing you can do for your expenses as well. So if you are, you're having different marketing expenses. So you have your Facebook ads, for example, if you have your social media ads, or your, Google ads, or you're doing advertising in magazines, you can break that down into advertising costs for the different sectors that you advertise in. So then, when you do your management account analysis, you'd be able to get an idea where your income streams are strong, where your expenses are very high, and then that'll help you analyze your accounts better and then make informed decisions about your business as well. Touching on bank reconciliation here. So I'm hoping most of you are using a cloud-based accounting software of some sort. So be it Xero, Free Agent, QuickBooks, etc. I mentioned Free Agent only because if you have a NatWest business bank account, you get Free Agent accounting software for free with it. But do be wary of the NatWest bank account transaction charges. So just something to think about. What you do is you link your bank account to your accounting software, as you must have done already if you have a software. And it then pulls all your banking transactions into the software, all your incomings and the outgoings. What bank reconciliation is, essentially, is allocating all those incomings and outgoings to the different ledger accounts. Now, I've given an example of your recycling bins here. So ledger accounts are essentially like your different bins, and you're allocating each of your incomings and outgoings to the different bins or accounts, your ledger accounts. And that is all bank reconciliation is. What I would highly recommend is every time you do a bank reconciliation, which is essentially the allocation of your expenses, make sure you give a little bit of an explanation as to what that expenditure relates to. Also, attach invoices or bills, some form of evidence of those expenditures. Tomorrow, if you have an HMRC audit, you know exactly what those expenses relate to. You can provide supporting evidence. So it's very important that you do this when you're doing your bank reconciliation so that you don't spend hours and hours later on trying to work out what it was that you spend money on. Try and do your bank reconciliations weekly. I see that most of you have your accounts up to date. Superb. But please try and do your bank reconciliations on a weekly basis. This will help you not just to avoid fraud, because this has happened to one of my clients where they weren't doing their bank reconciliations on a regular basis and money was being withdrawn out of their bank account, which they weren't aware of. So please keep on top of your bank reconciliations. I can't stress this enough. So you can avoid fraud. You can do your VAT returns quite, smoothly. And also your year-end accounting process becomes very smooth. Besides that, you can analyze your management accounts very quickly, make quick decisions with regards to your business, which can save you lots of money. So moving on again to the bookkeeping basics about journal entries. Now, you've done your bank reconciliations, all your double entries in order. There are entries that do not affect your bank account, and these are called journal entries. More often than not, your accountants will pass these journal entries for you. But to give you an example of what a journal entry is, if you, we all do this, we use our personal bank account in order to pay a business expense. So when you do this, how do you record it in your books? Obviously, it is a business expense, but you have paid it out of your personal bank account. So what you do is pass a journal entry in your accounts. So you debit the expense or the asset or whatever you have spent money on, and then you credit the director's loan account. So essentially, it becomes like you are giving a loan to your business. Now, be careful, There are also times where you will be using your business to pay for maybe some personal expenses. All of us do that. Nothing to worry about. But if you do regular bank reconciliations, you can keep an eye on your director's loan account, because any personal expenses that you pay out of your business also will be debited to your director's loan account, because it's not a business expense. So you need to be careful about whether your director's loan account has gone into debit or if it's a credit, which means whether you have given a loan to the business or whether you've taken a loan out of the business. Now, it's very important to keep a track of this, because there are tax implications. If you are taking money out of the business as a loan, so if the director is taking loan out of the business, then there are tax implications, not just for the business, but also for you personally. So please, another reason to keep your bank reconciliations up to date, because then you'll ensure your director's loan account is not going into debit. Therefore, a loan taken out by yourself doesn't happen. Yeah. There is a bit of time that you have to repay if it does go into debit. So it's not the end of the world, but just keep on top of it. Now, the trial balance. So you've done your double entry, you've done all your reconciliations, you've passed all your journal entries. You come to the trial balance. Trial balance is essentially a list of all your ledger accounts with the balance at the end of a period. So if you want a trial balance for the end of the month, end of June, say, for example, the balance in those ledger accounts as of the end of June will be listed out. And the trial balance is just that. The ledger accounts, all the different ledger accounts, and their balance at the end of a particular period. If you prepare, or when you prepare the trial balance at the end of the year, these are used to prepare your statutory accounts, your year-end accounts that you need to submit to the HMRC, Companies House, etc. Okay, so this is how the bookkeeping world, mystical world of bookkeeping works. Now, I wanted to touch a bit about on pricing and margin. Now, we all are running our businesses, even if it is a charity, even if it is a nonprofit, we want to make some money out of it so that we can use it towards either for yourself, for your family, or if you're giving to charitable donations for that purpose. So it's important that you get your pricing right. And there are many factors that affect pricing. There's loads of information out there. I'll just touch upon a few things. The most important thing, the cost of your product or service. And when I say cost, I mean all the costs that relate to bring the product or service to a saleable condition. If you are importing goods from outside of the UK, then it means transportation costs, the cost that you pay to your supplier. If you're producing a product, then it involves the materials purchase, the labor involved, the electricity consumed in order to produce the product, everything. So everything that goes towards creating that product or service and bringing it to a saleable condition. That's what the cost is. So make sure you've included all those costs. Value proposition. What is the value that a customer or a potential buyer allocates to your product? This is really important, because if they think it's really high value, it means that you would be able to charge a higher price for it. If they think it's not that big a value to them, then you may not be able to charge a very high price. So this is very important. What's your point of differentiation? What's your USP? Competition, of course, you have to look at what your competitors are charging for a similar product. Do your market research. VAT and duty. Now, what I found is very often people forget, if you aren't registered for VAT, now this is particularly if your products are VATable. If your products are not VATable, you can find from HMRC website whether or not your product is VATable. Sometimes there can be a little bit of a gray area, but you can always speak to HMRC to work out whether it's VATable or not. Now, if your products are VATable, and if when you're pricing your product, you forget about VAT because you're thinking, I'm not registered for VAT. Why do I need to charge VAT on my products? Remember, assuming your business is a growing business, there will be VAT, you could potentially cross the VAT threshold, which means that you will need to then charge VAT when you start selling post-registration. So it is important that you do consider that in your pricing as well, because customers are very price sensitive. You start your business 6 months down the line, you cross the VAT threshold, and then you start charging the 20% VAT. People might not be happy then to pay the extra 20%. So do please factor that in. If you're importing your products, there's duty to pay. Therefore, you need to consider that in your product or service cost. So that's something to consider. And of course, your pricing objectives. What is it that your objective is with your pricing policy, marketing strategy? Do you want to get into the market, penetrate the market with low prices, and then gradually increase the prices? Or do you want to sell your product as a luxury niche high-end product? So depending on that, your pricing obviously changes. Another thing to bear in mind is if you are supplying your product or service to a retailer, especially a product, they will expect you to then do some promotions with them, quarterly money off, like if you're supplying to Tesco's or John Lewis or whoever, they might want you to do some promotions. Well, they will want you to do promotions. Therefore, when you do your pricing, especially for this retail market, you want to consider those factors as well, and calculate the discounts that you might need to offer and build that into your costing. Usually, we have 3 different prices. One is a distributor price. The second one is a wholesale price. And third is a retail price, depending on who you're selling to. So if you have a distributor who then proposes your products and sells your products to shops, you will need to sell it to them at the distributor rate. So always have a 3-tier structure to your pricing. Margins, profits. All of us are running this business to make some money. So you might have amazing top line, which is the turnover, but what about the actual profit margin that you're making? It's so important to keep your eye on that. And that's why pricing is important anyway, but also keep an eye on your direct costs. So as I already touched upon, these are the costs that are incurred to bring your product into a saleable condition, to manufacture them or to import them or to just buy them. Similar with the service, all the costs involved in creating that package to sell to somebody. So you have your direct costs, and then that then gives you the gross profit margin. Now, I give a lot of emphasis on gross profit margin in my business, certainly, because you have your turnover and you have your cost of goods sold or direct costs. And if you take off the cost of goods sold from the turnover, what you get is the gross profit. And the gross profit percentage needs to be a healthy percentage, because only if you have substantial gross profit will you then be able to cover all your other costs, which are your fixed costs or your indirect costs. Say, for example, you rent premises. These are your fixed costs. Irrespective of whether you sell your product or not, you have to pay your rent. So you need to generate enough gross profit to cover all those fixed costs as well. Also, if you want to take a salary for yourself, you want to have enough gross profit in your business. So please do, pay particular attention to your gross profit margins. Then you have your net profit, which is essentially your turnover less all your costs, fixed as well as the non-fixed or the variable or the cost of goods sold. So all your costs you take off from your turnover or your sales, and you come to your net profit percentage figure. Now, your net profit percentage figure might vary depending on what you decide, how much salary you want to take out of your business. If you decide, oh, I don't want to take too much salary out of my business, I want to take money out from my business in the way of dividends, in which case your net profit percentage obviously will be a lot higher because your salary costs are lower. So your net profit percentages can vary, but it's the gross profit that you definitely want to have a really healthy one. And of course, depending on which industry you work in or you produce in, your gross profit percentage, your ideal gross profit percentage can vary. So, be aware of what your industry averages and make sure you're earning at least that much. It could be 50%, it could be 80%. It all depends on how much your industry averages. So do keep an understanding of that. Now we come to the management accounts. And management accounts are just exactly that, accounts that are prepared for the management of the business, the owners of the business, so that you, as the owner or the management of the business, can understand how your business is doing on a weekly, monthly basis. And therefore, you can analyze the accounts and take informed decisions about the business. So you prepare a monthly P&L, compare it to the last few months, or compare it to the last year, or you might have a budget or a forecast, compare it to that. Compare the gross profit ratios for the different months, understand where your income is coming from. If you have broken down your sales, like we previously touched on, which is your strongest sales channel? What is the highest cost that you're incurring? Which month did you spend more money? Things like that. So keep an eye. Another thing I highly recommend that you do, this is to manage your cash flow. Generate your weekly receivables and payables report. Receivable means anything that people owe you that you are supposed to receive, and payables is anything that you're supposed to pay. So if you keep a track of what you have as payables and receivables, you will have a bit of an idea about your cash flow situation. So you have some money in the bank, there are these receivables, there are these payables. You have a rough idea about what your cash flow situation is going to be. And if it's tight, then you need to think about, do I need an overdraft facility? Maybe that'll help me ride through this tough cash flow situation. So many different things that you can consider to make sure that your cash flow is not too tight. So this is an example of a management account, so monthly management account. So you can see you've got 12 months, different, the income, expenditures, etc. If you see this line, there's the gross profit line here, and you can see on an average, the gross profit is around 53%. October 2020, the gross profit was much higher, fantastic. But then February 2021, the gross profit was much lower. Why was that? You can see that the costs in Feb 2021 were much higher, the cost of goods sold or cost of sales. So it's good practice to just have a look at this and understand what's happening in your business. The sales are much higher towards the latter half of the year. That does tend to happen. Christmas is busier if it's a retail business. And then when you look at the expenses, you can see that advertising expenses, for example, April 2020, more than double what you've been spending for the rest of the months. So, what happened there? Did we spend on a magazine advertisement, or maybe we did a billboard advertising? So it's something for you to think about and analyze and understand what's happening in your business. Where is your money going? So reflection, and that will then help you make decisions. And then you might think, well, actually, that was not a good decision to have done that big expense on advertising. That's really hurt us that month. Our profits might have gone low that month or the next month. So, decision making becomes a lot smoother if you have these management account analysis. And if you're using a software, cloud-based software, you can pull out these reports very easily into an Excel spreadsheet, and you can manipulate them in the sense, when I say manipulation, I don't mean fudge the numbers. I mean, do calculations on them. So, percentage comparison to previous period, or the gross profit percentage, etc. So always download it on an Excel format rather than a PDF format. Another example of management accounts, you have the cost of sales. You have the forecast, you have the actuals, and then you compare the two. You compare it to the prior year, again, see what the differences are. Do these ratio analysis, see the movement. You get an idea, you'll get a feel. And once you start doing this, you'll actually enjoy doing it, because then you'll be like, oh, I know my numbers. I know where my money comes from. And if you have split further down your turnover, your costs, or your expenses, you'll be able to see exactly what's happening as well. And then, of course, you have the year-end accounts, or the statutory accounts, regulatory accounts, whatever you want to call them. These are accounts that are prepared for the company's house, the HMRC, perhaps your investors. In order to prepare the year-end accounts, there are a few things that your accountants will do, or if you're preparing them yourself, you will have to do. One of them is stock. Now, If yours is a product-based business, then of course you might have stock, unless you're operating a just-in-time stock system where you prepare, where you produce stock only as and when you need. Then you will not have you have stock in hand. But please do maintain stock records. This exactly the same way you maintain your accounting records. It's very important that you also maintain your stock records. When you do this, you will also get an idea of how, try to work out what your stock life cycle is. How long are you actually holding stock in hand? If you're holding it for anything more than 3 months, 6 months, that's a long period for which your money is tied up in your stock. So again, that's going to make your cash flow tight. So please do bear in mind to check these little things, which will help you, breathe easy with your cash. You have your stock records. At the end of the year, it's good practice to do an actual physical stock count. So count all your stock, do a valuation of the stock, per unit. What was the purchase price at which you purchased your stock? Multiply it with that and get the value of your stock. Now, this will need to be, via the help of a journal entry, will need to be recorded in your accounts as well. The other thing that needs to be recorded as part of the year-end calculations is depreciation. If you have purchased an asset in the year, you will need to write it off gradually over the life of the asset, and that's called depreciation. So that's another journal entry that you'll need to pass for your finalization year-end accounts. Depreciation is also called capital allowances by HMRC. So if you hear the word capital allowance, don't worry, it just means depreciation. HMRC calls it capital allowance, and companies, the accounting standards call it depreciation. That's the only difference. Just a small tip here. If you haven't already heard about this, or your accountant hasn't already told you about this, HMRC had given some extra relief for certain qualifying assets purchased between March 2021 and March 2023. So if you have an asset which qualifies for this relief between this 2-year period, you will be able to get capital allowance, not just 100% of the asset, but 130% of the asset, and it's called super deduction. So do please, you can Google super deduction, or you can go on our website and you can read the blog that we have on there. Make sure you're claiming this, because this will give you some tax relief, obviously, because this means that your expenditure in your tax return, rather than being, so if you're spending £100 on an asset, you can claim £130 as an expense of that asset, which means that obviously 20% of that you save as tax. So please do make sure that you have factored this in when you do your tax returns. You've done all your finalization. You can close the books in your software. There's an option to just close it so that no corrections or no changes can be made to the closed books. This is an example of a micro entity accounts. There are exemptions for micro entities. So micro entities where your turnover is less than £632,000 and you have less than 10 employees, etc. You don't need to do as many disclosures. So you just need a simple set of balance sheet. You do not need your, to disclose your profit and loss account to the company's house. So it doesn't become public. Your balance sheet will, but not your P&L. That's it. There is hardly any disclosure requirement as far as company's house are concerned for micro entities. So, make sure you're not disclosing too much information, unless you want to, of course, then, feel free. So that's what, you've done your bookkeeping, you've done your bank reconciliation, your year-end accounts, etc. You are doing this yourself or you're outsourcing. I noticed that nearly 50% of you do it yourself. If you're doing it yourself, and hopefully you're not spending weekends doing it, and you're not spending more than 10% of your day doing your accounting, it might be worth considering outsourcing. Now, many people ask me, should I just do it myself? Now that I know how to do it all myself, let me do it myself. Absolutely, you must do it yourself so that you know how it is done. But remember, that's taking away your creative time from developing your business to doing admin work. So you'll be ending up working in your business, but not on your business when you start doing your accounting work or your admin work. So even if you have a small budget of £25 a week, it might be worth considering outsourcing or finding a bookkeeper to do your books for you. If you have already outsourced it, fantastic, which is what most of you have done, and your books are up to date, excellent. So this is just to give you an idea. So that's the end of the webinar. Thank you so much for listening to me. The recording will be shared with you. Thank you again.